Peter Kinch here, and welcome to the webinar series part 12 with Equicapita Income Trust. And on the line with me tonight is Steve Elliott from Equicapita. Steve, welcome.
Thank you very much for having me, Peter. This is great.
You know, we got a rarity here in Vancouver. I don't know about your neck of the woods. You're calling from Calgary tonight, but you're in Calgary, right?
You got that correct, and yeah, I know where you're going with this. I'm looking out of my front window right now at my home, and it's miserable.
Yeah, you guys have rain, and we got sunshine. Wow, you know, there you go. I'm not feeling bad for you because it's about time for us to have a little bit of the sun, and we never know how long it's going to last here. So listen, let's jump right into this. There's an old Chinese proverb, Steve, that says, "May you live in interesting times." And I got to think, and the reason it's a Chinese proverb because it can be good or bad. And my goodness, I can definitely say we're living in very interesting times here right now. Literally 1 hour ago, for those of you who do not know this, but an hour ago, and Steve, you probably don't know this, in British Columbia, our political history is virtually changed, and a historical event happened. The recount, the absentee ballots were just counted on Vancouver Island, in a small town of Courtenay Comox, where the NDP won the seat there by 9 votes. The recount has just increased that lead to over 180 votes. So the NDP has taken Courtenay Comox, which now means the Liberals have a minority government, which means the Green Party and the NDP, if they chose to form a coalition, will be the ruling party for British Columbia. So talk about interesting times. You have an NDP government in Alberta. And we're not going to get political. This is not about politics, but it does speak to the economics of the situation. And of course, going down that political road, we have to also look at south of the border. And my God, what's happening in the Trump era? I just finished a Mortgage Minute video that went out this morning to all my clients, Steve. And one of the things we talked about is the potential for a impeachment of President Trump in the United States, and how that may impact a wide variety of things, including the public markets. So, as I say, may you live in interesting times. I think it's safe to say we're there.
Absolutely. There's no shortage of drama for sure, and for myself, I guess I try to avoid the television. So we kind of turn off a lot of the outside noise when it comes to investment decisions for sure.
Good call. So everybody's like, okay, that's interesting. What's that all have to do with investments? And one of the things I've been talking about for a long time is that I'm an absolute firm believer that every single Canadian should invest like a pension fund. Steve, you and I were talking about this earlier today. Canadians should invest like pension funds, endowment funds, institutional funds. And the way that the institutions and the pension funds and the endowment funds and quite frankly, a lot of high net worth, ultra-rich, ultra-wealthy investors, the way they invest is that they don't put all their money into one asset class. They can have it spread out into obviously the public markets, and but also real estate, direct ownership of real estate. And that the other class and category that a lot of people aren't familiar with is private capital. And private capital is investing in the ability to invest into a particular business. Tonight, we're going to be talking about one example of one of those private equity investments, which is Equicapita. And Steve, before we jump into this and get into the legal disclaimers, well, maybe we'll start off with that first and say, okay, let's touch on the legalese of this and make sure that we're protecting ourselves as far as the Security Commission is concerned in terms of disclaimers. Do you want to touch on that?
Yeah, absolutely, Peter. Really appreciate the intro. I guess there's you can see that this is in about a 3 font, so you'll notice that there's about the third line down. Forward-looking statements. We're both going to use a lot of forward-looking statements tonight. Obviously, anticipate, believe, plan, should, project. So yeah, we want to throw out the disclaimer on that, as well as the fact that Peter is registered with the BC Securities Commission. And if you're looking for advice for any type of investment, make sure that the person you're dealing with is registered with the Securities Commission. And yeah, that's why Peter's able to do this call today.
Perfect. And yeah, this is not a direct solicitation. It's more for educational information. Any forward-looking statements are just that. Actual events and facts may change through the course of time. So I think we covered off the legalities of such. So first of all, let's talk about yourself. We're going to jump into Equicapita as one of the many funds that are a part of the Capita family of funds. So Steve, tell us a little bit about yourself and how you came to work with the Capita funds in the first place.
Yeah, no, actually, and I don't even know if you know the story, Peter, but I guess I've been in this industry for 15 years. And I started off in the insurance side of the business and got a mutual fund license in 2003. And was very fortunate that I was dealing with a lot of high net worth families. I'm a farm kid by nature here in Alberta. And so I had some wealthier families that said, Steve, with all due respect, you cannot sell us a mutual fund. And I said, well, what do you guys look at? And they said, well, Steve, you see that hotel over there? You see that gas station? We built those. Mm. And needless to say, they kind of educated me on what they look for in an investment. And they said, well, if you get rid of your mutual fund license and you want to look at the private side, we would love to work with you.
Really?
So yeah, I was fortunate enough to have a great relationship with their accountants. And I would just basically source deals. I would look for deals. And every time I would send them over, they said, Steve, why don't you come over and we'll go through this with you and tell you what we like and what we don't like. And, in that way you can, cherry pick the better deals that we want to see moving forward. And so
these are deals you were interested in investing in.
Yeah, and obviously 15 years ago, being green in the industry, you really not, I didn't know the difference between a good deal, a bad deal, and an ugly deal. And so needless to say, these guys would go through the due diligence process with me. And it was really just a great place to learn. And I was fortunate that these wealthy gentlemen would pay for the accounting group's time to do the DD, and I got to work alongside these guys.
Mm-hmm. DD, but for those who aren't sure, aren't aware, that's due diligence. And the industry being now, when you mention the industry, you're talking more about the private equity arena.
Correct.
Right, and that is that is an area that's evolved significantly over the past 15 years, and very much so in the last 5 years.
Yeah, very much so. I was in this space 10 years before it was regulated, and obviously to see the regulation happen, which it was needed. If from a lot of people out there, anybody and everybody that wasn't registered with any securities commission could sell these investments just by having an agency agreement. Today, you have to actually write exams, have qualifications, and actually be registered with securities commissions across Canada. So, needless to say, that's added a lot of credibility. We've seen a lot of the issuers now that are put through the ringer by a lot of these investment dealerships that have been created over the last 5 years. So it definitely has added a lot of credibility to the space for sure.
Yeah, no, again, and then that's where the birth of companies like TriView Capital came from, and that's, it's hard for a lot of people. It's so many different terms out there. You hear about these exempt market dealers and TriView Capital and Equicapita. Every one of these companies have a different capital attached to the end of their name. So at the end of the day, again, for everybody out there, we're just trying to give you a little background on how the evolution of the space, if you will. A lot of high net individuals, high net families have been involved in this space for ages, but it's only since the average investor's gotten the opportunity to work through exempt market dealers and private equity firms like the Capita family, the Capita group, that the Securities Commission has basically come in there and said, well, if the average individuals starting to put their RSPs and TFSAs in here, we need to really regulate that. I think that's the area that's probably seen the biggest change.
Very much so, Peter. That's a great point. And I think that, the Securities Commission's, real job is to protect, I always say that years of my, parents and grandparents, which is something that didn't happen prior to 2010. And there was a lot of situations that happened mainly here in Alberta that, unfortunately, when the economy is doing very well, everything's rosy. But unfortunately, we know what happened in 2008, 2009, and there was some private deals that blew up, and there was no regulation on concentration. So if somebody wanted to put their entire net worth into one project, they could. Now, you and I both know that can't happen today with our investment dealerships and compliance officers, and it's really about investor protection for sure.
Which is fantastic, and again, for everybody out there, it's just phenomenal opportunity that's been created here because the Securities Commission has come down and really regulated the industry and for the benefit of you, the average investor, so to speak. That what it's done is it's created rules, regulations, and restrictions as to what an individual can do, so it's almost protecting them from themselves to a certain extent. But what it also provides is an opportunity for someone looking at their RSPs and say, you know what, hey, I want to take about 20% of this and put it into the private equity space, and then out of that 20%, I might divide it into 4 or 5 different types of companies, and one of those companies could be Equicapita. So there you go. There's your segue into Equicapita, and specifically, well, before we talk about Equicapita, talk about the Capita family. We have the slide up here saying the Capita family of funds. So tell me a little bit about the Capita Group.
Absolutely, Peter. No, thank you. First and foremost, we started in 2007. Just to let everybody know on the line, this is, unfortunately, with new regulations in the last year, PowerPoints that we show have to be filed on CDR. So needless to say, this is a little outdated when it comes to some of our numbers, but obviously we have to show, we can't basically show you information that hasn't been filed on CDR like public entities. So today we're about 700 million assets under management, and that's just recently after all our audited financial statements. But we essentially have 5 different investment silos. And if you look here in Calgary, we have 5 separate offices and different management teams, different accounting firms, different controllers on each fund we manage. So we were the first RSP-eligible farmland funds in Canada.
Oh, really?
Yes. So started Equicapita in 2007. And we've been fortunate. We've exited our first 2 farmland funds at a 15% IRR on our first fund, and our second fund was a 16% IRR. And so we've been very fortunate.
So IRR, again, for those on the call, internal rate of return. So 15% internal rate of return, not a bad return. No, that's annual.
Correct. Yeah.
Those are some historical numbers. We're going to be touching on some of the other products you have here and focusing tonight on Equicapita. And just as an aside for everybody on the line, we are actually planning to do subsequent webinars on Agcapita and Petrocapita. So just touch very briefly, a teaser for everybody so they come back and listen to the next webinar. What's Agcapita?
Yeah, so Agcapita, well, first and foremost, there's numerous reasons why we love the farmland space, but we focused originally in 2007 on Saskatchewan farmland because it was trading at $300 per acre per ton of wheat production. So when we're looking at any asset class, we break it down on the productive capacity per acre side of things. We look at farmland. So we started buying farmland in 2007 at $300 per acre per ton. Today, it trades about $1,100 per acre per ton. But if you look at Ontario and BC, they trade at $3,000 per acre per ton. So there's still this, significant discount. In actually, Alberta trades about $1,400 per acre per ton of wheat production. So
and what's Saskatchewan right now?
$1,100 per acre per ton.
Wow. So again, to skip over the obvious, ag stands for agriculture. So it's an agricultural fund. Wow, there's something very different outside the box that a lot of people would never even think about in their current RSPs.
The funny thing is, Peter, is the one thing that we do a phenomenal job at is risk management as a group. We don't have any leverage on any portfolio we manage currently. So those IRRs were unlevered returns. So we're about risk-adjusted returns. We believe if you've got a significant discount or on the ability to acquire cash flow cheaply, you don't need to add leverage to your portfolio, which essentially adds risk because in bad times, we all know, especially us here in Alberta, banks are your friends until they're not, especially in recessionary times. They pull lines of credit very quickly on the investment side. So we don't ever take that risk into the portfolio. So, those returns are done on a risk-adjusted basis. And we're also very disciplined. We're also groups of guys, when we go in to look at any asset class, we know when we're going to start, and we know when, the price comes back, we stop. We actually capped our Capita funds this year in February just because we said, no, the pricing's way higher than what we were originally paying. And we capped our fund at $165 million we raised in less than 2 years. So we're very disciplined on not only the buy side, but knowing when to stop, and then we always look for an exit. Every one of our funds, and this is one thing you'll find different with the private equity space versus the actual public market space in typical mutual funds, there's no exit plan on a mutual fund, where every one of our funds, we have not only a plan to buy, but we have an actual exit strategy behind every one of our funds.
And that's huge because there's one of the reasons people invest in the private space is to get a cash flow return, but also a potential upside on the growth of the product or the company that they're investing in.
Very much so. No, I think that, a lot more people that I meet on the street nowadays are saying, geez, my entire portfolio is basically correlated today. I just need something that is maybe a little out of the norm that, if you look at, agricultural land, especially in Canada, 2008, 2009 with the downturn, farmland went up 13% and 14% year over year in Western Canada when the TSX was trading at 8,000.
Yeah, so again, just for everybody on the call, that is a term, Steve threw out a term, and I'd like everybody to write it down, non-correlated assets. Correlation is a massive component to a proper investment portfolio, and that's why some of the ultra-wealthy institutional funds, pension funds, endowment funds all have non-correlating assets, real estate, private equity, and the markets. So it's not a case of one being better than the other. It's a case of the combination of all three of those integrated into a holistic plan, but non-correlated. So it's like, if the markets were to tumble tomorrow, gold would go up. So some people say, well, it's good to have bullion in your portfolio. But I don't think many people sit there and say, yeah, it's good to have farmland too. Hey, listen, we don't want to give it all away. We're going to do a separate thing all on that next time, okay? So we'll do a separate webinar on that. Let's switch to Equicapita, because I can imagine some people are going, oh, oil and gas, yeah, just avoid that like the plague right now. My goodness, Alberta's in the tank because oil is down. I mean, the last thing you want to do is be investing into oil and gas at this point. Is that right or wrong?
Peter, I always go back to the oldest philosophy in investing, and everybody always says they want to buy low and sell high, but 91% of people buy high and sell low. It's because, and unfortunately, I don't have a slide to talk about it today, but we always talk about three major biases that all of us face as investors. The first one is the herding bias, because, you're looking at all your friends, well, what are you doing? What are you doing? And they're all telling you, oh, I've done so well the last 3 to 5 years, and I'm going to pick on, Vancouver real estate. I've done really well. And so they're going to say, well, I should be buying it right now. And then the next major bias after herding bias that we all face is confirmation bias. And I'm really guilty of this because I don't believe that oil is going to be at $20 in the next 2 years, but I also don't believe it's going to be at $200. So if somebody's talking $50 to $70, I'll listen to that conversation and I'll read that article. But if people are, have an actual, entire thesis behind why it's going to go to $200, why it's going to $20, I think they're crazy. So we really do confirm our own biases. You watch television stations that confirm your own bias. So
yeah,
those are two major biases we all face. So we have herding bias, we have the confirmation bias, and then the last one is recency bias, because the most recent thing you heard, you probably believe. And so when we look at any asset class, and that's why we're in 5 separate asset classes, is first and foremost, there has to be the demand moving up, which if you look at oil and gas, when we went into this downturn in 2014, the world consumption level on a daily basis was 92 million barrels per day. And you guys can
92, okay.
We're at 98 million barrels per day of consumption today.
So consumption is going up.
Absolutely. And now the sad thing is if it's not negative, it's not news, right? Mm-hmm. And the front page of the paper is always going to be the negative headlines. So anytime we look at any asset class, we always look at, well, how do we turn the music off? How do we turn the television off and take the biases out? We build investment models that tell us when to buy, and more importantly, tell us when to stop, and then tell us when to sell. And so if something happens to any one of our investment managers, we always have that discipline to, still know when to buy and when to stop.
That's awesome. So if I could summarize again, because we'll do this in a separate webinar, but if I could summarize this really quickly, the bottom line is for those who wish to participate and diversify some of their private equity component, again, you're picking a percentage of your overall portfolio, putting it into private equity, and then a percentage of that you're throwing into different various companies. So if you say, okay, I'm going to throw a little bit of money into the oil and gas sector because I believe that there might be some potential for some good buy opportunities should oil really rebound price-wise, Equicapita would be the vehicle for that. Was that an oversimplification of the program?
Yeah, I'll be the I'll just give you a little teaser on some of the we had 7 acquisitions in 2017. You want to be the guy with cash and no debt, which we had no debt. Mm-hmm. One of the acquisitions, Peter, just to quickly go over it, There was a company here in Calgary called Palliser, and they'd spent $127 million. They had 19 water stations. They had 12 water disposals wells. They had 77 kilometers of pipeline, 2,300 barrels of production, and actually had done a great job of actually building up this entire pool of assets. About 50,000 acres of actual mineral rights, and had a $65 million line of credit with a major bank that foreclosed on them when they actually, their reserve report, dropped below the 50% covenant. They hadn't missed a payment, but because they breached the covenant, they got foreclosed on, and unfortunately, with hardly any buyers around, they were offered $35 million within 30 days, which they declined. They said, we're not taking less than 50, and then fast forward, 12 months later into 2016, and they said, well, we have to go into binding rounds, and we just have to take the first basically legitimate offer that'll buy this entire package up. That's how a lot of receivers work. We were able to pick up that entire package for $3 million.
$3 million.
$3 million. We were actually
it was 35 just 16 months earlier.
Yeah, and they'd spent $127 million.
Wow. Okay, there's a teaser. We'll do another webinar on that. So okay, so the Capita group of funds, the Capita family has agriculture, oil and gas opportunities, separate funds, and of course, what we're going to be focusing on tonight is Equicapita. Equicapita buys businesses. Now, before we jump into talking about that, I got to share something that I came across, and I shared this on my webinar today, my Mortgage Minute video that I sent out. I came across this article. I was just on the internet, and it was an article about how ultra-wealthy family offices invest. And for those of you who aren't familiar with, family offices are private offices of families who might have, like, let's say, $100 million to invest. So imagine if you're a family, if you're a family with $100 million, I don't know, you're probably not listening to this webinar, but if you were in that position, you have the ability to go out and pick and choose what you're going to buy in. So again, going back to what I said earlier about how you as an individual Canadian should be investing into your retirement and your pension portfolio. And Steve, a lot of my listeners and a lot of people in my database are real estate investors, but they also have RSPs looking to diversify. So what's interesting is if you look at people with over $100 million to invest, where are they placing their money? Well, much like your own portfolio, the ultra-wealthy diversify capital between stocks, bonds, various investment funds, but unlike your portfolio, a growing number of families are making direct investments in companies, either purchasing them or funding their growth. I read that and I thought, wow, what a perfect segue into tonight's topic of conversation, because you might sit there and say, well, good for them. If I had $100 million, I'd go buy a company too, but I don't have $100 million. I'm looking at $10,000 or $20,000 representing, if I look at 20% of my overall RSP portfolio, I might throw $10,000 or $20,000 into a fund, but how can I, with that little money, go out there and buy a company? Well, I think that creates a perfect segue for what Equicapita does, because, and I'll pass this over to you, Steve, but Equicapita basically creates a pool of capital that goes out there and buys private companies. Yes?
Well, thanks, Peter. And just to elaborate on the ultra-high net worth, 70% of the capital we raise at the Capita funds is institutional money. We do have a bunch of pension funds invested across all 5 silos, as well as when I talk ultra-high net worth, we have 3 of Canada's top 10 wealthiest families invested in our funds as well. So
repeat that, because that's important. Could you repeat that last statement?
Yeah, so 3 of Canada's top 10 wealthiest families are invested in some of our funds. So
wow.
Needless to say,
there you go.
They invest in funds alongside of people like you and I. So, yes, they do go after buying a lot of these businesses directly, but sometimes they want the wheelchair investment, just like you and I do, that allows them to collect essentially an interest rate and not have to bring in the expertise themselves.
Wow. Well, a great example there of exactly what we've been talking along. Okay, so let's jump into it. Equicapita. What does Equicapita do?
Yeah, so needless to say, Peter, there's no secret behind this large cohort being the baby boomer demographic, essentially. That's obviously there's numerous books been written about it. pig in the python. You basically, a lot of people have always said demographics are people's destiny. What we found is if you look at the average business owner today in Canada is 60 years old. The average doctor is 60 years old. The average financial advisor is 60 years old, as well as the average farmer is 60. So needless to say, we've identified over 60,000 businesses in Western Canada that fit our criteria between that $5 to $30 million enterprise value. And the reason why we go after that, what we like to call the nano or micro niche, is the fact that there's very few buyers in that space. They're generally too big for mom and dad to buy for a son and daughter, give them 20 to 40 employees to manage. But yet, they're too small for the big private equity firms. There's quite a few big private equity firms in Vancouver, Toronto, as well as New York. But a lot of times it's not worth getting out of bed for that $5 to $30 million enterprise value.
So you're talking about small, medium enterprise. Give me an example of what that would be. Like, when you talk about small, medium enterprise, this would be a baby boomer that might have started his own company. Let me just throw out one example.
Yeah, actually, one of our latest acquisitions, which I'll actually specifically talk about each company here in a little while, is based in Burnaby, CC Met. They do environmental testing. They do about 85% of all Lower Mainland environmental testing. They have 14 separate offices. They were the private business of the year in 2014 and 2015 in British Columbia. So anytime anybody wants to put a new building up or pavement or concrete, there's essentially a set of engineers and scientists that go and have to do the final sign-off on it. And that's what CC Met does. And we like that we're long regulation with that business. I think they have about 240 employees and been in business for well over 30 years. So the number one thing we're looking for with any business we look for is minimum 20 years of operating history. And the reason why we picked 20 years is you can see how they formed essentially in the financial crisis of 2008, 2009. And you can also look at how they performed in the tech bubble in 2001, or essentially the 9/11 crash in 2001. So we're looking for boring, non-correlated businesses. So
boring, simple, non-correlating business.
Yeah. So if it's some sort of business that is maintains their cash flow throughout those recessionary times, those are the type of businesses we like to look for. I mean, I look here in Calgary a year ago, oil's trading, it's $26 a barrel, but yet you've got Walmart that's completely lined up, as well as Costco. There's businesses out there that thrive in good economic times and bad economic times, right?
Yeah. No, fair. Now, it's something that a lot of people aren't familiar with is the term EBITDA. You've got here to date, Equicapita has raised approximately $100 million. I know at the time we did this when you put this PowerPoint slide together, it was about a year ago, and it matched the offer memorandum you had at that point.
Correct.
Now that number is larger. I know you have to be careful. You can't state specific numbers until they've come out in the offer memorandum. But suffice to say, that number is larger today than it was at the point you made this PowerPoint.
Correct. We've got 6 investments now, and we'll talk about the 5 companies today. And we've raised about 120 to maybe 125 million. And then EBITDA is essentially just your earnings before interest, taxation, depreciation, and or appreciation. So, and that's around. We're still right around that $19 million mark as well.
So you're targeting companies that have earnings before taxation, depreciation, etc., of $19 million, give or take.
No, that's if you look at our 5 investments, that's what the earnings would be currently. Probably our number one criteria is we need to see minimum earnings of $1 million on an annual basis before we'll look at the business with 20 years of operating history. So yeah, we've got a pretty definable criteria for sure with businesses.
Okay, excellent. Okay, so talk about the ownership group. I mean, obviously, when you look at going out there and buying a business, even if I had, $60, $70, $80 million, I wanted to go buy a business or whatever, $10 million, that's not to say I've got the expertise to know what to look for and how to go find or identify something to purchase. So part of the benefit of working with a fund like yours is piggybacking off the expertise. So I think one of the things for me when I look at this, okay, the concept sounds great. I totally get the fact that there's a bunch of baby boomers out there looking to diversify and divest themselves of their businesses, and their kids don't want to take over the company. So if I'm going to invest with your company, I need to know that you have a management team with some track record success and knowledge and ability to deliver on this.
Yeah, very much so. And Peter, I guess with you coming from the real estate realm, one of the first things they always say in real estate is location, location, location. And I coined the phrase about 6 years ago that in private equity, it's really about management, management, management. And
good point.
Our guys are top quartile in pretty much numerous aspects and varied backgrounds in private equity, which is always good. There's nothing worse when you look at a team and they all came from the same location with the same set of skills. Because they're not going to look at deals differently. And so, just to give you a little background on the three of our trustees, the three founders. Now we have an entire management team behind them. We have another couple of portfolio managers that work directly with these guys. But these are the three founders of Equicapita. Michael Cook, over 15 years working with small and medium enterprises. He's a chartered business evaluator as well as a chartered accountant. Started his career at Deloitte and Touche before he moved over to Ernst & Young. And Stephen Johnston, his partner, he's a lawyer by trade, has his MBA from London Business School. He is the original founder of Agcapita and the Capita funds. I call Stephen a little bit of a beautiful mind. He's written a few books. He doesn't own a television. He reads about 50 books a year.
Wow. I've actually read, working through one of his books is called Cantillion's Curse, which, by the way, if you have a chance to pick that up, it's Cantillion's Curse. It's he was an Irish economist back in the 1800s, if I'm not mistaken. Is that right?
I believe you're correct. Yep.
Yeah, and that's who Cantillon was, and it talks about the money markets and the threat of our international financial system today being overdependent on governments printing money. Totally different topic, but fascinating read. So yeah, interesting guide for sure.
And ironically, if you look at the three of these gentlemen, they actually wrote a book together called What Next, and they wrote it for when they started Equicapita. They said, how are we going to meet a lot of these business owners? And so they wrote a book. It's called What Next, and it's really about succession planning for business owners.
Right.
And so if there's anybody on the line that knows anybody in that baby boomer demographic that's looking for some succession planning help, and it's not a book on, the first thing you do is talk to the guys at Equicapita and sell us your business. Absolutely not. We specifically tell people, by the way, you need to get a good advisor involved to let you know what your business is worth. Is your goodwill worth anything? Should your business own your real estate, vice versa? So it's a really good 101 for business owners. And actually that CC Met deal I told you about earlier, we actually acquired that business, 70% of it for $27 million. And he had an offer for 70% for $28 million and took our offer because of that book. So
interesting.
Just that education of us sending that book to our that owner, and he's still very active today, 75 years old, and just loves what he does.
That's fantastic. And Greg Tooth will be the last director on the list here.
Absolutely, and Greg comes from a private equity background as well as a commodity trading background. He's a chartered financial analyst. He's actually been in part of numerous kind of groups of guys that have done this type of fund before, where they've had 3 or 4 businesses. The one group is still operating today, that they still have their businesses, and he's still part of another group on that side of things. So, kind of always been in that private equity space on the acquisition side of things, really good on the implementation side of things as well. So all 3 very, very sharp men.
So suffice to say, you've got a strong management team and then a support team behind that. So again, got the slide here, number 8. What do we do? How do investors benefit? So why don't you touch on this?
You know what? I really like this top line. Is real estate and private business ownership represent foundational investments of high net worth individuals. Now, typically, many portfolios have real estate exposure, but private businesses is very tough to get exposure to. So that's we're very much a differentiated fund out there for sure. What do? We're looking for boring, profitable businesses. And when I mean boring, the number one thing we typically stay away from is the service side of oil and gas. We just don't believe you can control that commodity risk. And so we obviously, residing in Alberta, we're very cognizant of that. And so we like boring. We don't want sexy. And so that's kind of why we like stability first and foremost. You as an investor, you're getting the first 8% of our cash flows from our businesses. And this is what we call our preferred C securities, and we'll explain that on the preferred side of things after. You also get growth in the portfolio. So after our 8% hurdle rate is met, you also get free common equity growth, which allows you not to just be held down with just getting 8%. There's an incentive for our management team to get you over and above that original 8. And then we always, we believe that you can't get stability, income, and growth without that focus on safety. And we currently have 0 bank debt. Our maximum bank debt we're allowed in the offer memorandum is 25% loan to value.
But you have no debt.
We have no debt. We just don't believe in debt as a return driver. We believe that if you're buying cash flow very cheaply, there's no reason to take that leverage risk for sure.
So from an investor perspective, they're investing into a pool that goes out there, identifies potential opportunities, businesses that they can purchase, that has stability with a proven profitable business that you guys have done your due diligence on and say, okay, yeah, this is a good company to buy. It's going to create an income stream of at least 8%. And the first 8% goes to the investor, and then there's also a growth upside, obviously. We're going to touch on how the money's made and how that structure looks a little later for you as an investor. But I think what's really important, and we've touched on this a number of times, is where the opportunity lies for Equicapita. One of the things that is on the headline of your brochure says, invest in one of the largest generational transfers of wealth in Canada's history. That's a pretty bold statement. So maybe touch on a little bit about what's happening in the marketplace and why this is such a great opportunity for investors and for Equicapita today.
Well, it comes down to our investment thesis, right? So anytime you see a supply and demand imbalance, and you see a ton of supply on the amount of cohort trying to sell, but yet you see very few opportunities as far as funds out there with organized capital trying to buy. So if you see demand on the sell side, but you don't see demand on the buy side, it allows you to get great economics. And so and it allows us first and foremost to get deal flow. And so if you look at CIBC's statement, an estimated $1.9 trillion in business assets are poised to change hands in the next 5 years.
I have to pause you there. That's something no one should you can't just blow past that. that's crazy. That's $1.9 trillion in business assets poised to change hands. Now, above that, you've got the 2009. Just speak to that slide. What do you mean? That's the difference, 14% to 27%.
So that means essentially the amount of retirees is going to double over the next 20 years. And so,
right.
And it's over 90% of businesses right now in Canada are owned by that cohort.
That's a huge thing that's underestimated. I mean, we all know. I mean, there's, it's no secret to say, oh, yeah, there's a bunch of people retiring. No kidding. But the fact that a large percentage of those people are self-employed. I mean, it was interesting. I was speaking to an audience in Toronto and Alberta, going across the country with the RAIN group recently, and at each meeting I said, how many people in the audience are self-employed? And like 60-70% of the hands are going up, and a lot of them had gray hair,
Yeah.
So, or no hair. What's interesting, I think that's a statement or statistic that's really underestimated. Not just people retiring, but businesses retiring. What's happening to them?
No, absolutely, and obviously, Globe and Mail, more than 500,000 small business owners are planning to retire in the next 5 years, and another 750,000 by 2020. And anytime you can have deal flow, it allows you just to be extremely picky. Which anytime you're looking at any investment. You want to see tons of deal flow that you can be picky and you can make sure you pick the right one and not the other way, right?
So that's upwards of 500,000 small, medium enterprise businesses that are looking to retire. And the way they retire means what? Sell the company or let the kids take it over, right?
Yeah, and we're just not finding a lot of the next generation wanting to take over a lot of these businesses. And for us, we don't want to tell the owner to essentially walk away. A lot of these business owners, especially when they've been there for 20 plus years, they know every employee very well. They know their families,
mm-hmm. Yeah.
And we really just want it to be a smooth transition. So, And the number one thing that we want is that continuity of keeping the great management teams on board. So when we invest in them, they also invest in us. Each one of the owners, when we're buying these businesses, are pretty much keeping probably a minimum of $1 million into Equicapita shares, like you and I as investors. So they have a ton of skin in the game with us as well.
Well, okay, so this is not like the movie Pretty Woman where Richard Gere comes in, buys a company for pennies on the dollar, rips it apart, sends the old man packing with pennies instead of dollars, and just gets rid of all the employees, and is just the evil. You guys aren't the evil guys that go in there and tear things apart and sell them for pieces.
No, because of the way our buyouts work, I mean, a lot of it's financed by the owner. Typically 1/3 of the sale price is deferred. And a lot of them are sticking around these businesses, minimum, anywhere between 3 to 5 years. Some of them are sticking around even longer. But needless to say, it's a transition, and you want to have good relationships with these people. Otherwise, you notice that the next level of management's not happy if the original owner's not happy. So, you really do have to try to be cognizant to keep a good relationship, and pay them fair market value. Absolutely, we're typically paying 4 to 5 times cash flow for these businesses. And that's market. That's what we're looking to pay.
So it's a great win-win. And a lot of these people don't have a lot of options out there, do they?
No, you're right. And what we're finding is, you have, and you're right. It's also the sense that they don't have a lot of options. And one of their number one things, I mean, some of these people are fairly well off. It's not that they want so much money. It's that they want their employees taken care of. And so, they're finding it's got to be a win-win, right? Where, they're getting some cash. And a lot of them, their entire net worth is in these businesses they've ran for 20 to 30 years, right? So it's, something that they want to see a smooth transition out, and they don't want to completely retire and have nothing to do either, right? So.
Yeah. You got some comments here for RBC, MNP, Deloitte. Basically, this is speaking to the fact there's limited competition equals good returns.
Very much so, and it's funny that MNP and Deloitte, there's a lot of deal flow that these guys send us, but again, RBC, relatively low valuations for many businesses in the current economic environment could represent a largely unrecognized buying opportunity. M&P come out and stated that business owners are seeing that there's a lot of competition when they go to sell these companies that they've worked so hard to build. And then Deloitte, with a glut of baby boomer-owned SMEs, small and medium enterprises, essentially available right now, there's an untapped and growing opportunity for Canadian private equity firms to realize significant value at the low end of the microcap market. So, it's always nice when we're not the only ones out there saying it, for sure.
Yeah, well, again, that just creates a very good, it shines a light on the opportunity here and how a company like Equicapita can come along. And what's interesting for the listeners on the call is, like, again, Equicapita's investment opportunity is RSP TFSA eligible, so everything you're reading here through a vehicle like Equicapita gives you an opportunity to invest and basically participate in this whole process, this trend or opportunity, so to speak, while minimizing your capital outlay or risk. So again, that all sounds wonderful, but there's risks to any investment. How do you guys mitigate that risk?
Yeah, and Peter, you're bang on it. If you ever seen any Capita presentation, usually we have anywhere between 2 to 3 slides minimum on risk management. It's always in our focus. I've mentioned a lot of these key things already. For us, cash flow we believe is king. So we like to see a long-term history, minimum 20 years of stable cash flow. Senior management will remain in place even if the current owner sells, and so we really dig into who the key people are, try to tie them up for that 3 to 5 year window as well, and give them performance-linked compensation as well. So you make sure that they're hopefully entrepreneurial minded, and they want to work harder. If the business makes more money, they make more money. So we always want to incentivize them.
Sorry not to speak over top of you and interrupt, but I think that's key. And I didn't even realize that myself before this call, that the key management stays on. And from a bit, it's different. Sometimes I compare what you do to, on the real estate side, people understand the concept of going out there and identifying a building that's been undermanaged or a little tattered and disrepaired, and then you can go in there, buy it cheap, fix it up, paint, lipstick, increase the rents, and all of a sudden the cap rate is better, and you can make more money by flipping it and selling it. So in some ways people think that's what you do, but it's a little bit different, isn't it?
Yeah, we're not looking to we're not looking for broken businesses. We're not looking for wow, we're getting a great discount because their cash flow's dried up and they're just not running it properly. We want it to be the other way. We want it to be a great business that's just been consistently performing. The owner's like, no, it's time. I just need to step away. I don't want anything to change. They've got all the controls in place. They have policies, procedures. A lot of these organizations are 40 to over 100 employees. So there's a lot of key people there for sure.
So do the employees kind of welcome you guys coming on the scene?
We've been fortunate. Obviously the owner's the one that we originally deal with, and then they're the kind of ones that kind of sell the next next level for sure. And we always want to make sure that we have great relationships with those key people. Otherwise, it's just not a fit, right? And
well, I wonder that because if I'm looking at this from a risk perspective, I might say, okay, that is great, but you're going to go out there and buy all these companies of baby boomers looking to unload off you, and maybe the staff all just says, hey, we're loyal to that guy, but we're not loyal to you, and we're just going to tank this thing, and next thing you know, you got this albatross that's losing money, and investors start to lose money.
Well, first and foremost, that's why you keep all your key managers in place with performance-linked compensation. You have non-competes anytime you're buying a business, and yeah, there's lots of just little simple things you can do with every business you buy to make sure that the key people stick around. By all means, will there always be turnover in every business? Absolutely. You can't control everybody by all means, but we've been very fortunate to have very, very low turnover for sure, and that's just always been the case for us for sure for the last 4 years.
Now, you talked about the three key managers at the top, the directors of the company. There's a whole team behind them that is involved in the actual day-to-day operations. I mean, imagine as you currently have, in this presentation, we're going to touch on 5 companies. You've got 6 altogether that you're buying. What's the target of the fund, first of all? Like, how many companies is this fund eventually going to have under its umbrella?
Yeah, we're currently at 6 businesses we own, and we're looking to have the portfolio anywhere between 15 to 20 businesses. Each one of those businesses will have separate economic drivers. We're not looking to layer on repeat drivers with same businesses by all means. If we, and I'll actually, Peter, if you want to go to the next slide, I'll go through each of these individually.
Yeah.
So Levy's was our...
What we'll do is we'll just touch on each one. We got about 10 minutes left in the webinar here, so we'll touch on each one quickly then.
Yeah, absolutely. So yeah, you'll notice all 5 very differentiated. First business we bought, Levy's. They deal in numerous industries here, based in Calgary. So they deal in the mining world, the agricultural world, oil and gas. Long-term management already in place with as well as the key operators, and then our 2 second-level guys or performance-linked compensation.
What does that mean? 2 key. Sorry, I don't understand what that means. 2 key second-level managers on performance-based.
Yeah. So then, not only our key operator we kept around, we also kept in the second-level managers as well, and so we try to tie up all the key people.
Okay, so their compensation is based on performance.
Yeah, absolutely.
Gotcha.
So yeah, if you want to go to the next slide, we'll touch on Meter Core. Meter Core is the people that replace most of the smart water meters as well as the natural gas meters across Western Canada. We love it because it's in the utility sector. Kind of, once again, boring, but they also get to do all the maintenance work on a lot of these water meters as well. In 1997, they replaced all the water meters in Calgary, and 5 years later, the technology was already outdated, and they had to replace them all again. So, constant repeat business. And, we don't look at, on the last line, it says growth industry. There's not a lot of places in the world that actually meter their natural gas or water. So, we do see a little bit of a growth profile. We're not looking for any growth in these businesses. We generally buy them on good metrics, but we do believe there's probably, a little bit of a growth profile on Meter Corp for sure.
Now, the last thing you got there, vendors are long-term partners in Equicapita and accepted $1.2 million of the purchase price, 17% in preferred trust units. Just touch on what that means.
Yeah, so each one of these companies, when we buy them, we want to invest in them, and we want them to invest in us. So accepting, part of that, I think it was about a $10 million acquisition. Don't quote me on that number, but let's say it's around that. Well, yeah, I guess it was 17% of the actual purchase price. They actually invested into Equicapita preferred trust units like you and I as investors. So they are in the same fund that you and I are in.
Wow. Okay, so, that's what we call alignment.
Very much alignment. It's the question you asked earlier about, why isn't this guy going to open up a business across the street? Well, that's why. He's got 1.2 million invested with us. He wants to see Equicapita succeed for sure.
Yeah, but not to mention the fact he's one of those baby boomers, and the reason he's selling in the first place is not to go start another
very
business.
Much so. So yeah, actually, in the third, the Major Core and A&R have a few things in common. They both actually had absentee owners. So key management was already in place. Owners were living in New Zealand and UK for the last 6 to 7 years, and we're both kind of sick of filing taxes in Canada, needless to say, because they've been gone for so long, and that's really why they offloaded these two businesses. But A&R, based in Richmond, I've been around since 1969, 70 employees. Anytime you see something on a Freightliner or a Kenworth, a Peterbilt truck that's stainless steel, more than likely these guys have the patent to build it. And needless to say, yeah, we tied up the key managers again. And yeah, you can look on the bottom line, it's accepting 1.5 million in preferred trust units as part of that.
Key managers are in agreement, are motivated through performance clauses, and the owners and partners have invested into Equicapita. Steve, I'm going to put you on the spot here. You shared a story with me the first time we met, and it was going back over a year ago. You shared a story, and I don't know if it was A&R was the example, but there was a company where they had a machine that was kind of stuck in the corner, and it received things from all 4 directions, but the machine was in the corner, and therefore non-productive. Do you remember that story?
Yeah, absolutely. So our full-time vice president of operations is a guy named Matt Barr. He's a Six Sigma expert, and started his career at John Deere before he moved over to Ford. And Matt's a kind of guy.
Six Sigma expert, for those who don't know, what is Six Sigma expert?
Really just an operational, supply demand, type expert, I guess, on that side of things. So MBA, he's a very sharp guy by all means, but he's very cognizant of how he's, working with these owners to tell them that, we should maybe move things around from an operational efficiency standpoint. And so they were just saying, oh, things get, clogged up here. And he said, well, if we pulled that away from the wall, we could not use, use this machine from 2 different directions. We can use it from 4, and this would probably not get bogged down. So needless to say, Matt's also, other part of his job is that we have a program called our Echo One system, so our operational network of excellence, where we systematize every part of these machines onto real-time data. We know our supplies, we know our sales, and so we can see a lot of these machines operate from our office, which is a great way that we can systematize things.
So that's a really important point, because it's not like you guys go in there, throw some money at the owners and say, okay, we now own this. The owner buggers off to retirement, and then all of a sudden the employees are kind of going, whatever, and just really, we don't really, or you've really kicked off the employees. This new ownership group comes in there and starts trying to tell everybody what to do. One of the things you shared with me, Matt, is really good, and it's Matt, right?
Yeah, absolutely.
Yeah, Matt goes in, and he, as an operations manager, basically engages with the employees and helps increase optimization and efficiencies.
Very much
resistance.
So. Absolutely, yeah. I mean, you hope it's not without resistance, right? I mean, you can't tell people to do things in a lot of businesses. You have to work with them to hopefully they understand why you want to make that decision, right?
Absolutely, that's awesome. Northwest Crane.
Northwest Crane, one of the largest truck-mounted crane businesses in Western Canada. Do also the boom and truck, the picker trucks as well. One thing that we did face in 2016 with the recession here in Alberta is that they had a lot of the business coming from the oil and gas sector, and we definitely did see a decrease in their numbers by all means, and that's something that we have no qualms about talking about for sure. But anytime you're building a portfolio, you're probably always going to have 1 or 2 non-performers, and when you have 6 businesses, we understand that's part of the cycle for sure. So they deal in numerous industries. They also deal in the utility sector, forestry, and construction as well.
So that's a really good point. If one of these companies, and we'll go on to CCMet for next, but if one of these companies was just to go in the toilet and just, okay, we blew it on that one. How does that impact the investor?
Well, it's a portfolio, right? So I mean, anytime you're buying into a portfolio, you're not buying into one company. You're buying into $120 million of capital that you have $10 million of capital went into one business and it's not performing. Well, you'll have other businesses that keep the portfolio going, and that's one good thing about
so like a mutual fund almost. A mutual fund of companies, so to speak.
Very, very much so. And I mean, could you imagine if that was the only business we owned? Obviously you wouldn't be happy, right? So, and that's why you want different economic drivers with every business, is that you want that non-correlation to one another, right?
So you got a non-correlated asset in private equity with non-correlated business, a company in Equicapita that buys businesses, and internally the companies they buy are non-correlated. So not a lot of diversification within diversification. Totally makes sense. CCMet.
Yeah, so I've obviously tooted their horn a few times already. Over 250 employees based in Burnaby. 12 of their 14 offices are in British Columbia, and deal in numerous industries as well. We don't like businesses that are only tied to one industry typically, just because you're kind of tied to that, especially when you think of the energy sector. But we like the fact they deal in the mining world, the utility space, oil and gas, forestry, infrastructure, and we own 70%.
Environmental testing's huge.
Absolutely, it's not going down anytime soon.
Yeah, that's a large growth space in itself. One of the things that it just dawned on me, like, again, even if I had the money to go out there and buy a company, do I have the expertise to know what to look for, what not to look for, what are the red flags to avoid, et cetera, et cetera. We don't have time to go into all the details how you guys go through that, but suffice to say, the assumption here is that you guys have that expertise, and then even within that expertise, if I were to go out there and start buying companies, I might buy one or two and be very vulnerable to one of them going down. So I like the fact that you have 5. Now you've got 6 and growing. Okay. Last 5 minutes here, Steve. Let's jump in and talk about the actual investment opportunity itself and how that's structured, because you touched on the fact you got preferred units and common shares. That can all get really confusing to people. Do you mind explaining that a little bit?
Absolutely, Peter. Can you just click one more thing here? I think we can. Oh, sorry. I guess you better go. We had to go back to that last slide, and I'll try to explain it here. Needless to say, so if you look at the top line, our preferred shares, which you have an 8% distribution on, so the income side, we pay 8% annually. We pay this quarterly.
Okay, that's not guaranteed, though, right?
You're correct.
You're targeting that. I mean, that's the objective here. Just be clear.
Absolutely. Now, we've never missed a distribution since inception. We're just over 4 years. And this is what we call a preferred C trust units, and those shares are available for $1. And then, needless to say, you'll see that plus the 0.001, so a tenth of a penny for your Class A common shares, which essentially gives you on the growth side. So those common A LP units are zero cost, which a tenth of a penny. This is where the equity upside and excess distributions and or capital gains would kick in. So yes, we're buying these businesses at 4 to 5 times cash flow, which is essentially 20 to 25% per annum. So there should be some residual cash flow and equity upside that would continue to compound in our limited partnership, which you would get basically for those for free. So now this is what they call a tied security. So every time we issue one preferred share, we issue one common. And so if you put $100,000 in this example, you would get an 8% distribution based on your $100,000 example in your RSP or any type of, whether you can have open money, that's fine. And then you would get your 45,000 common, and there would be 100,000 common units issued, which the other 55,000 common would go to our principal. So you're getting the exact same shares as our 3 trustees.
Okay. Well, I guess this is a good breakdown here.
Exactly, if you want to look at that slide. So yes, you're buying into the portfolio. You see in the bottom, all cash flows then push up through our limited partnership, which our first 8% of all cash flows have to go through our trust to give you, the reason why we have the trust there is that it offers us registered plan eligibility. And so that's where the first 8% of cash flows, and residual stays in our LP, which you get free common equity there as well.
So two things I want to clarify for listeners. Number one, there'll be two types of payment on this. One would be 8% preferred, which would be like income. From a taxation perspective, that would be taxable as income. Great place
Correct.
to park in a great vehicle to park in your TFSA, by the way, compounding tax-free. But also on the common shares, when that does pay out, that's actually returned as capital gain, so it's tax preferred there, right?
Yeah, so if we decided to ever do an eligible dividend, it would be considered to be an eligible dividend through the LP unit side. Or
Okay.
if we were to get bought out or take it public or have some sort of exit plan, yeah, that would be a capital gain as of today's taxation laws for sure.
Perfect. Don't want to get into the weeds too much on that, but there was one key component here for everyone listening that is critical, and I'm going to try to explain this, Steve. Correct me if I'm wrong. Okay, so as you go out there and you've purchased the 6 companies you currently have and cash flow enters into the corporation, one of the things you mentioned is that, or one of the most common things people say, well, what's the management fee? Because people are used to buying into stocks, bonds, mutual funds, and that sort of thing, and they all have MERs and management fees. Equicapita doesn't actually charge a management fee directly. The directors have salaries, and then once they take over a company, you've got obviously some costs and infrastructure involved there, but then the profit that flows through, the income from these companies, the combined income, has to hit 8% before Equicapita as a company can make any money. Is that correct?
Yeah, that's correct. So our 3 principals, who I showed earlier, their base salaries are $180,000 a year, which I realize for a lot of people in the world that sounds like a lot of money. But if you look at the 3 gentlemen's backgrounds and acumen and what they've done in the history, that's pretty cheap for those 3 gentlemen and a base salary for those 3 guys. Their real payday is the common units, which essentially they get if they hit their hurdle rates. So needless to say, they have a vested interest to add a ton of value in those common units, and obviously want and are very motivated to have it.
Those common units have no value until you've paid out the 8%. Is that correct?
Basically, yeah. I mean, it's an 8% hurdle rate, and I mean they're basically worthless until you have residual cash flow and above that, right? So, so yeah, that's really where their big payday comes in.
So again, bottom line for people listening is that it's what we call it means that the investment is in alignment, where the owners of the company and the investors rather are in alignment. In other words, they both have the shared common interest. The owners of the company, Equicapita, really only makes money from the common units, and in order to really make that money, they got to make sure that the limited partnership units or the preferred trust units get 8% return first. That's you as the investor get their 8%, and then everybody can share in the common unit profits. So I like that, and I wanted to emphasize that because much like previous webinars I've talked about, it means that the owners of the company are in alignment with the investors, and that is a critical thing. So they're not just sitting there and collecting salaries and going, well, we could care less whether the company makes money, we're making our salaries. They're motivated to make sure that those common LP units have value at the end of the day.
Absolutely. That's a great point.
Well, that's fantastic. Steve, I just want to say thanks a lot. I don't see any questions on the screen. Again, if anybody has any questions, fire them off to me. This is fantastic. And just in wrapping up, I just want to share a couple of things that I've been saying to my clients for a long time. Again, I shared this on my Mortgage Minute this morning about Thane Stenner's article in the Globe and Mail a couple of weeks ago, or actually it was back in January, where high net worth investors are putting their money right now in real estate. 30% of the Tiger 21 members are allocating, 30% of their capital is being allocated to real estate. And it's interesting, public equity and private equity is equal at 21% each. Again, it's a theme we've been saying all along, that high net worth individuals are diversifying how they invest, and that doesn't mean just oil and gas. It means that they're choosing real estate, the public markets, private equity. And that's one of the reasons a lot of you know that I've partnered with the Vine Group, and we have now launched Vine Wealth. Vine Wealth is, again, giving people the opportunity to diversify and look at another way of investing their capital. It could be 10 to 30% in real estate, 10 to 20% in private equity. It might be 50 to 80% equity in bonds. You can mix that up, but if it's real estate, we can help you with the mortgage. If it's private equity, Triview Capital, myself as a licensed exempt market dealer, can help you there. And we've got our portfolio partners, Lonsdale and Newport Wealth and Richardson GMP. So, really trying to provide a solution that can be a hybrid that can help everyone. And no matter what you do or no matter what you're investing in, make sure that you're basing it on the results you're getting. The gap should drive the bus. And if you haven't already, send me an email and book a gap analysis so we can determine where you are today, where you're going to be in the future, and help you build a plan to get there. So regardless of what you regardless of what you're investing in, you're basing it on the end results. So ladies and gentlemen, that is part 12 of the webinar series. There's my contact information. If you want to book a free consultation and have a gap analysis to determine whether something like Equicapita is right for you, send me an email, let me know. And last but not least, Steve, thank you very much. I really appreciate that. Was incredibly insightful, and really appreciated your sharing with us about Equicapita.
Thank you very much for having me, Peter. Really appreciate everyone joining the call tonight. Thank you so much.
And you know what, Steve, we're going to have you back. You're okay to, in a few weeks or a month or so, to talk about Agcapita and Petrocapita for those who are interested in that as well?
Yeah, absolutely, for sure.
Fantastic. Hey, ladies and gentlemen, that is a wrap on this week's webinar. So again, thank you very much, and I look forward to hearing from each and every one of you, and would love to be able to put together a gap analysis plan precisely designed and catered to you personally. Again, enjoy the weather, enjoy the summer weather, and we'll see you all next time talking about Agcapita and Petrocapita. Steve, thanks a lot. Been a great night.
Thanks. Thanks, Peter.
Okay. Thanks, everyone.